I'm Jesse Hooten, CFA charter holder. Today I'll be reviewing a company called TD Synnex. The company serves as a middleman in the tech supply chain, connecting thousands of IT manufacturers and resellers, helping businesses acquire hardware, software, and tech solutions. Annual revenue 25.7% over the last 5 years. Occupies a dominant market position represented by 69.7 billion in revenue and enjoys a significant fixed cost leverage. We've seen significant share buybacks over the last 2 years. Share buybacks kind of function in a similar way to dividends in that they increase the earnings per share for shareholders, reducing the share count base. 16.3% revenue growth last year. Company claims to aim to operate a business that performs reliably across economic cycles while improving profitability, return on equity, and free cash flow over time. Moving on to some multiples here. We'll start with the PE ratio for the last 12 months. In the top left, you'll see SNX, the ticker for TD Synnex, at 15.5x, which is well below the S&P 500, sitting at 27.4, and in line with the other comparable companies, above some, below others. You can see the historical trend line in the light blue for SNX, comparing the 15.5 PE ratio for the last 12 months with the PE ratio for the next 12 months. You'll see it drops to 11.6, suggesting growth in earnings over the next year, resulting in a lower multiple. Which is what we like to see. That correlates over to the PE to growth ratio, being the PE multiple divided by the expected growth rate over the next year, being right now around 26% in net income. The PEG ratio sitting at 0.88, well below the S&P 500, as well as many of its peers. So we like the position that we see on those multiples there. Moving on to EV to EBITDA, enterprise value to EBITDA. We like to use EBITDA multiples as it controls for depreciation and amortization, which can be unpredictable line items. Sitting at 8.5 times EBITDA, the enterprise value, it's well below the S&P. Again, sitting in a range that we like to see for the company in terms of the valuation. And similarly, we see on a next 12-month basis, the company goes from 8.5 to 8.6, so it doesn't change too much, whether it's backwards looking or forwards looking. Net income figures, still well below the S&P 500 and in line with the basket of companies that we have here at the top line. And moving on to some slides regarding TD Synnex, starting with some earnings multiples. We went over the enterprise value to EBITDA multiples. We see the trend staying more or less in line on a next 12-month to last 12-month basis, with the last 12 months to current multiples being slightly elevated compared to historical trends. We see that more or less across the board on this slide, as well as the EV to EBIT multiples, staying sort of in a tight range over the last 5 years, but slightly elevated in the last year, but still not beyond a range that is considered fairly valued for a company of this quality, in my opinion. And same with the price to earnings, on a last 12 month and next 12 month basis for this company. We're looking at 17.1 and 12.1 for the next year. So forward-looking earnings looking to improve on a next 12 month basis. Onward to a few solvency ratios, we'll see debt to equity, the company having more equity when compared to total debt, currently at 52% debt to equity, and that remains the case across the other debt metrics, suggesting that the company's capital structure is pretty strong, having more in the way of equity than debt or liabilities. Total liabilities to total assets trending up slightly over the last 3 years and into today at 76.8%, but not above levels that I would consider overly alarming. And then on to interest coverage, we have EBIT and EBITDA over interest expense with multiples that are healthy and above or in line with some comparables that I took a look at for a company of this quality. We'd like to see. I want to focus on the current and quick ratio. The current ratio, essentially, it's current assets divided by current liabilities. For that ratio, we like seeing an above 1 ratio. So 1.2 suggests its short-term assets are in excess of its short-term liabilities. The quick ratio is a more conservative version, modified version of the current ratio. It takes away cash and cash equivalents, it only includes cash and cash equivalents. Investments takes away assets that may not be its nearness to cash isn't immediate. So that's why you see the ratio drop a little. We like to see that, if closer to 1 would be really strong, but nothing of concern as far as its ability to meet interest expense and its credit capacity on this thing here. On to a few fundamentals here. We have the gross margin table for TD Synnex. Starting in 2021, that's pre-merger between TD and Synnex. That's why the revenue was roughly half of what it was the following year. In the top line, doubling to 62 billion from 2021, and then dipping slightly and recovering in 2025 with cost of goods sold performing similarly. We'll see margin expansion in the bottom line in yellow since pre-merger, expand by roughly 1%, suggesting that the merger was a success on this metric, with the gross margin expanding from 5.9 to 6.9. On to operating margin, we'll see the margin from 2021 to 2022 drop a little bit in the merger year between TD and Synnex, but expand to 2.26 in 2025, suggesting that it took a little time for the synergies between the two companies to come to fruition, but ultimately was a success, seeing an expansion of 0.57% since the trough in 2022. Wanted to note the operating cost line since 2022 stayed roughly in line, pretty flat, suggesting that the company enjoys significant operating leverage, meaning that when its revenue expands, its operating margin benefits disproportionately due to the concept of operating leverage. On to free cash flow margin. Margin's pretty low, hovering at 2%, dipping in 2022. I like the free cash flow margin in that it's an indication of the cash that the company is actually generating, whereas net income can hide or be supported by accounting measures that don't actually represent real cash coming into the company. Free cash flow is a measure of, it keeps things honest, you could say, with the company, given that it sidesteps accounting sleights of hands. This is an important metric to follow and make sure it's strong. CapEx since 2021 has stayed pretty low, so pretty much
all operating cash flow flows directly into free cash flow for this metric, suggesting discipline when it comes to CapEx. And on this slide, I'll note receivables turnover has not deteriorated from 2021 to 2025, suggesting that the revenue expansion that the company's seen has not been a result of lax or aggressive credit terms, but rather actual cash that the company is generating. Receivables having a higher turnover, meaning that the company is it's generating cash for its goods and services at a faster rate, which is what we like to see, having that number higher, meaning that essentially we're not waiting to get paid for the work or the service or the goods that we've provided, and that's a strong indication as to cash flow integrity. The fact that revenue has been what it is without a deterioration, decline in receivables turnover, suggests that the company has maintained its cash flow integrity. For this slide, we've calculated return on equity as a multiplication between profit margin, financial leverage, and asset turnover. Profit margin, the top line, being around 1%, pretty low, pretty thin profit margin, which is standard for the IT space, leaving return on equity largely being driven by the other two components, financial leverage expanding from 3.36 up to 3.9, suggesting the company is relying more on its balance sheet to generate returns for shareholders. Going back to the debt to equity ratios we looked at, it was still not alarming to me. It was in line with comparables that we took a look at. So it is relying more on its leverage to generate return on equity, but then that can suggest a deterioration in the debt coverage for the company. But in this case, nothing alarming as of yet. And then over to asset turnover, we see an expansion from 2021 to 2025, suggesting the synergies from the merger are coming into effect. And then the return on equity also expanding since 2021 on to 2022, the year of the merger, and then to breaking through 10% in the last year. Finishing off with my favorite slide for the video, we have a sensitivity table for TD Synnex. It's a discounted cash flow of its free cash flow to equity. Essentially what I do is I take the last 10 years of free cash flow to equity, take the average, I assume the growth rate of 10% over the next 7 years. Just a basic assumption, it's a pretty blunt assumption. And then after 7 years, 5% into perpetuity on the far right column, and then 4%, 3%, 2%, and 1% from right to left at the top into perpetuity. On the left are different discount rates from 7 to 11%. So based on the assumption of the average last 10 years of free cash flow to equity and 10% over the next 7 years in terms of growth, and then into perpetuity, let's say of 4%, the 4% on the top column there, and a discount rate of, let's say, 10%, that would suggest, based on this valuation formula, somewhere around $228 would be roughly the intrinsic value of the company on a per share basis. If that's a little bit conservative, using the last 10 years for free cash flow to equity might not be fair, given so much has changed and that the next 10 years almost certainly won't look like the last 10 years, so it is conservative. So I would say anywhere from using a discount rate of 10 or 9% and then a growth rate into perpetuity of 4 or 3%, or maybe even 5%, according to a more optimistic outlook for the company and the future of AI, could suggest that maybe the the quadrant or the cell that's in between the 4% long-term growth rate and a 9% discount rate at the $277 per share, that might suggest that is the intrinsic value for the company. The company trading as of end of day July 23rd, 2026, sitting at 247 US dollars. That would suggest that it's roughly in line with the assumptions that I made just offhand. But there are more optimistic outlooks for this company. And with that said, given the quality of the other ratios that I looked at, I would place this company as a buy. Of course, this is not financial advice. This is just my opinion. Do your own research. I'm not your financial advisor. But it's looking at, I was thinking $250 would be about fair for the company. It's currently sitting at 247 with upside that is seemingly, who knows where the AI space might go over the next few years. So I will place this as a buy for this company, just given the quality of the other ratios and the fact that the share price, based on a pretty conservative free cash flow to equity discounted cash flow valuation, in my opinion, shows that it's roughly in line with what my assumptions were. Thanks. I'll see you next time.